Petronas is cutting its capex by 21% for FY20 from its initial estimate of 50 billion ringgit amid a challenging landscape arising from the supply-demand shock seen in the oil market this year. It also announced a 12% cut in operating expenditure. Petronas says it will strive as far as practically possible to minimize the impact of the cuts to its Malaysian capex program, previously planned at around 26 to 28 billion ringgit this year before the multiple crises hit. This announcement came as Petronas declared its first quarter of FY20 numbers, where net profit fell a whopping 68.3% to 4.52 billion ringgit compared with 14.25 billion ringgit previously. This was unsurprisingly due to rock-bottom oil prices that are currently trading at 20-year lows. While it was a slight improvement quarter-on-quarter, it still represents Petronas' second lowest quarterly revenue since the second quarter of FY16, when net profit was 1.62 billion ringgit. Overall group revenue fell almost 4% to 59.6 billion ringgit. Going forward, President and CEO Tan Sri Wan Zulkifli Wan Arifin is blunt about how this could be a loss year for the oil and gas industry if the current market situation persists and prices remain low. All players will ultimately suffer and Petronas would not be spared. As such, the national oil player will focus on preserving cash, its current cost compression efforts, and respond with pace to current market conditions. CIMB Group Holdings saw its first quarter of FY20 net profit plunge 57.4% to 507.9 million ringgit due to a bump in provisions and lower non-interest income. This as revenue remained fairly flat at 4.1 billion ringgit. Net interest income grew by 4.8%, supported by a 3.8% improvement in loan growth as costs were kept under control. However, profitability was affected by a mix of volatile trading conditions, lower forex income, and isolated credits, which gave rise to increased provisioning in certain markets. CIMB says that after a tough quarter, it expects the rest of the year to continue to be challenging. But the bank still feels that the sector is still resilient and better prepared to weather the oncoming storm. On its part, CIMB is looking to speed up its digital initiatives to provide a more seamless banking environment for its customers in the new normal going forward. Public Bank's net profit dropped 5.7% year-on-year from 1.41 billion ringgit to 1.33 billion ringgit in the first quarter of FY20 as a result of lower net interest income following the 2.5% reduction in the overnight policy rate during the quarter. This was despite an improvement in loan growth. In a filing with the bourse, the banking group said quarterly revenue dropped marginally to 5.52 billion ringgit from 5.57 billion ringgit a year ago. The group did not declare a dividend for the quarter. Meanwhile, gross loans grew by 12.5 billion ringgit or 3.9% to 332.9 billion ringgit as at March 31st from 320.4 billion ringgit a year ago, driven mainly by the growth in mortgage financing, hire purchase financing, and corporate lending. Founder and Chairman Emeritus Tan Sri Dr. Teh Hong Piao cautioned that banks would be facing higher earnings pressure this year amid the extremely difficult economic conditions and persistent cuts in the OPR. However, he added that the group's strong fundamentals and resilience will allow it to withstand any challenge and pursue further business growth when the economy recovers. Gross impaired loan ratio remains stable at 0.5%, while its cost-to-income ratio is an efficient 35.7%. Sime Darby Plantation saw its net profit for the first quarter of FY20 surge over sixfold to 394 million ringgit thanks to higher earnings from both its upstream business and Sime Darby Oils. Revenue improved 2% from 2.99 billion ringgit to 3.04 billion ringgit. Chairman Tan Sri Abdul Ghani Othman attributes the satisfactory results to the group's ability to capitalize on the industry's brief respite from low CPO and palm kernel prices. However, he added that the group remains aware that times will continue to be challenging amid the COVID-19 pandemic. Meanwhile, Group MD Mohammad Helmi Othman Basha says the group is prepared to embrace a new normal and will implement extra precautionary measures to ensure the well-being of its employees as well as to minimize potential disruption to its operations. On its outlook, SDP expects its performance for FY20 to be affected by the volatility of CPO and palm kernel prices on top of the impediment to operations if the pandemic persists. Malaysia Airports Holdings slipped into the red for the first quarter of FY20, posting a net loss of 20.4 million ringgit compared with a net profit of 149.58 million ringgit the year before. In a bourse filing, MAHB says revenue dropped 25.4% at 933.84 million ringgit as passenger movements contracted 23.9% as a result of the COVID-19 related travel restrictions. Specifically for its airport operations revenue, top line for the segment was 25.1% lower at 877.7 million ringgit. As for its non-airport operations, revenue declined 30% or 24.1 million ringgit due to lower revenue from the project and repair maintenance and hotel businesses. Outside of Malaysia, the group's Turkey and Qatar operations saw their revenues declining during the quarter. Going forward, the airport operator says as the aviation industry continues to get hit by unprecedented travel restrictions and bans, it has started to proactively execute a group-wide optimization plan to ensure the group is able to meet its financial and operational obligations.